The S&P 500 could lose a quarter of its value next year in 2025, according to Stifel. The S&P 500 looks like it's in the midst of another mania, and investors could see a steep drop in the benchmark index sometime next year. Investors could be impacted long-term, as manias tend to lead to poor returns in the next decade. So Stifel is an investment firm, and they specialize in equities research analysis. They're looking at a lot of the same things that I've been seeing and that I've been questioning this whole year, along with a lot of other people. So look here at this graph. This chart is dated back all the way to 1885, and you don't need to understand everything here, but what you do need to see is that a trend and pattern has emerged for when a drastic stock market drop might happen. The market becomes overvalued and then drops hard. This has happened 4 prior times, and right now looks like the possibility of a 5th time, since we're in the same exact uptrend as the past 4. I'm going to share my analysis on what I'm seeing in the stock market in the next year, and then also what I believe is going to happen in the next 5 years and how I'm going to be investing. My name is Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. Strategists at the investment firm pointed to lofty valuations, with the S&P 500 breaking through a series of record highs this year on the back of an improving economic outlook, expectations for Fed rate cuts, and hype for artificial intelligence. But the benchmark index now looks similar to the past 4 manias that have taken place, the firm said, comparing the current investment environment to the pandemic stock boom, the dot-com bubble, and stock run-ups in the 1920s and late 1800s. Growth returns excess of value in today's market look almost exactly the same as they did leading up to the 1929 stock crash. Most intelligent investors that I speak with feel the exact same. It makes little sense that an economy being as bad as it is that they needed to actually cut the rates, and in an economy that had inflation soar, and at this point we're laying off more people than ever and people's credit card debt is going through the roof, it makes little sense that the S&P 500 just keeps booming. I mean, right now it's up over 30% in the past year. That's a little bit questionable. Strategists said if the S&P 500 follows the path of a classic mania, that implies the benchmark index will rally to around 6,400 before falling back to 4,750 next year. So what does that mean for my investing and for your investing? Well, I do see the merit behind a lot of this, and I actually do believe that the stock market could drop next year, especially at the beginning of next year. And I do believe that the stock market is a little bit overvalued at this point. I actually definitely believe that in the next 5 years, the S&P 500 will be way higher than it is today. I believe that there is a chance that the stock market drops next year, but if you don't need the money next year, then why does it matter? I'm not investing in order to take out my money short term. I'm investing for the long term. And so if the stock market does drop a whole 25% or something crazy next year, all that's going to do is help me to buy in at smaller prices, be able to get more for my money, and I'll be taking any cash reserves I have off to the side and be throwing that in, because that price will be amazing. For those who are relying on this money though, if you're relying on your investments, maybe you're in retirement and you're using that money, and so if a market drops, that's going to be a big deal for you. I totally understand this is a different conversation. So to prepare, I would recommend that you become proactive today. If you're relying on this money and the stock market does drop, then what I would recommend is that you have at least 1 year's worth of living expenses off to the side in a high yield savings account or CD or in cash. Preferably one of those first two, so that you're at least earning some interest. I would recommend that you have at least 1 year's worth of living expenses, but if you can get up to 2 years worth, that'll make you even more safe. So then if the market does drop, then you take money out of the high yield savings account or CD instead of taking it from the investment that's down. Then during that time, you're able to take money from your cash reserves and let the market kind of drop and come right back up, and it doesn't hurt you in any way. Then later on, when the stock market is back up, then you just replenish the savings accounts for any time that might happen again in the future, because our market is very cyclical. For those of you that don't need the money next year, but you just don't want to see your total investment account down 25%, I get it. But I would highly recommend that you do not just take all of your money out of the market right now and put it off to the side thinking that we're possibly going to have this drop. Timing the market is incredibly tough to do, and most people cannot do it right. For me, I'm keeping my money in the market, but with any substantial drop, I'm just going to continue to dollar cost average, but then I'm going to throw in whatever extra money I have sitting off to the side, because at those prices, that's going to be very attractive. I actually believe that in the next decade, we might see some of the biggest returns that we've ever seen in the history of the United States and the history of the S&P 500. There's a perfect storm brewing, especially around artificial intelligence and a lot of other things. Top strategist Tom Lee has made millions of dollars being right in the market, and he actually has a crazy prediction for where he thinks the S&P 500 is going to be in just about 5 years.
There's a couple of reasons behind this. One is this would be the third time that stocks entered a cycle where annual returns compound at high teens. You know, you had the roaring 20s, and then you had the 50s through the late 60s. And this is a third cycle. They all coincided with a surge in the number of people aged 30 to 50. So in other words, the number of prime age adults. And this time it's powered by millennials and Gen Z.
So is this the law? Okay, so math. I wasn't not great at math, but I'd like to think I know a little bit. Big numbers get bigger faster. That compounding.
That's right.
And you think there's that, but there's also this massive wave of people about to enter their peak earnings years.
Yeah, so it's a...
Demographics.
Exactly. It's a demand story, meaning when you get to your prime years, 30 to 50, Urban Institute shows you start to borrow more money. You're making big life decisions. This is what powers the economy. On top of that, we have a really a big opportunity for U.S. technology companies because of AI, which is supplying the global digital labor because there's a global labor shortage. So these two forces are combining to, I think, power almost a decade of extraordinarily good stock returns.
The S&P 500 tripling in 5 years or so is pretty crazy. And just remember that Tom Lee is one of the biggest market bulls out there, so we do have to take what he says with a grain of salt. But I do believe that he is on to something, and I do think that we're going to see some insane gains. I could definitely see next year being rocky, but the outlook after that looks very, very good. Stocks could be challenged next year due to the uncertain outlook for Fed rate cuts. While the Fed has signaled more cuts are coming, central bankers also risk undermining their inflation goals if they cut rates too soon. The conclusion is that if the Fed cuts rates in 2025 absent a recession, then that would be a mistake, with investors paying the price in latter 2025-2026, based on historical precedent. I'm staying the course, but not blindly. There's a definite chance that the market drops, and I'm going to be prepared, and I hope you're prepared too. Follow these videos to prepare further and to get you set up and ready so that no matter what happens in the market, your portfolio is optimized and you're ready to go and get those gains.